Dog day for the markets. Peter Hugg will tell us why coming up on For Pete's Sake. And joining us now is Peter Hugg. Pete, thanks for joining me today.
You're welcome, Alec.
So, Peter, what's going on with the markets now? It seems like a pretty slow day. Gold's been trickling down since hitting its summer high of $13.39 earlier in the summer. What are you making of the market right now?
This market is a very typical summer market. Over the past few years, we've seen summers where the markets have been more active, but this is the market I grew up with as a boy. I mean, by boy, I mean in the 40 years I've been in this business, 95% of July and August trading months have been absolutely dead, characterized by very thin volume, lackluster interest in the market, and the market is trading off news points, and whenever something exciting comes out, albeit the move doesn't last for a long time, you get a sort of a knee-jerk reaction, be it the employment numbers on Friday that disappointed, that created a jerk back up in the market after Thursday's and Wednesday's economic numbers indicated that the Fed might tighten early. So it's a market that has no conviction. It's very, very thin, and traders are just basically trying to push it around.
Now, when you say headlines, what kind of headlines are we talking about? Are we looking at more U.S. economic recovery, data points, that sort of stuff that's coming out, or is it more geopolitical tension, whether it's Russia and the Ukraine or the crisis in the Middle East that's currently ongoing?
These stories are, and I don't like saying it this way, but they're old stories. The Ukraine situation, is barely making the news on a daily basis. Although the Israeli-Hamas struggle, continues to be front-end news. Unless something changes significantly in both those scenarios, I don't think the impact on the metals is going to be from a perspective of higher. If anything, it might be from a perspective of pushing the metals lower, especially if the Israelis and Hamas come to some sort of an agreement that defuses the tension in the Middle East.
Let's take a look at equity markets now. They will be making more of a comeback throughout the month. What kind of impact do you think they'll have on gold prices?
It's a two-edged sword with the equity markets. I think if equities drop in a controlled fashion, then I think you could make a case that there'd be some diversification out of the equity side into some hard assets, which would include the metals complex. The danger with the equities, though, is if the market starts to cascade down. Investors tend to hold positions longer than they should, and what they're going to end up having to do is meet margin on some of these positions. And then they're going to be searching for liquidity to generate that margin. And unfortunately, many times that ends up being the precious metals that they sell to meet equity calls or margin calls in the equity positions. So it's a two-edged sword. If the equities just sort of soften off and fund managers are looking for some diversifier, I think it's beneficial for the metals. If it's a massive sell-off quick and 400 or 500 point type of drops, initially that could be extremely damaging to the metals. As people look to run to cash, and they'll throw the metals into that mix as well when they sell.
Now, with the market behaving the way it has, what's a key level that you're looking at for gold?
Well, from a technical perspective, and you almost need to trade this market from a technical perspective because the fundamentals are difficult to define here. There's conflicting influences on the fundamental side. But technically, you would want the gold market to hold that 200-day moving average, which is around the 1285 range. They tried last week to breach it, but they weren't successful. If they can breach 1285 in a thin market, which it continues to be, you get some computer selling coming in on a stop-loss basis. We could see a move, back down into the 1260s very quickly. If 1285 holds, which it has so far, the 92, 94 range seems to be resistance right now. We need a good, solid breach of 90, 94 with some momentum to test the $1,300 range.
All right, Peter, let's wrap it up with the gold-silver ratio. Now, silver has been under pressure lately. What do you make of the gold-silver ratio? Is it healthy? Is it unhealthy? What do you think?
Well, it's right now. It's in the middle. I mean, we've had a pretty consistent trade on the gold silver ratio going back almost a year and a half now. Silver approaching 67 ounces of silver to an ounce of gold. Suggested a long silver short gold play, and then as the ratio moved down to the 62 range, reversing that trade. And we had that opportunity about 6 weeks ago when silver was trading at about 67 to 1. And about a week ago or 2 weeks ago, it got down to 62. Now it's ranging closer to 65. So it's right at that midpoint range. There may be continued softness in that ratio again until we see 66 and a half, 67. At which point, again, we would enter the trade of shorting gold against the long silver position. So it's right in the middle. There is very little demand for silver. I mean, bear in mind that the industrial needs for silver, I mean, Europe is on holiday. When they shut down everything for extended periods of time during the summer. So none of the big industrial players are there. None of the big trading houses are there. So, that could change very, very quickly come closer to the end of August.
Great, Peter. Thanks for your time today.
You're welcome, Alec.
And thank you for watching this edition of For Pete's Sake. If you have any comments or questions, please send them to newsfeedback@kitco.com. Have a good one.